All right, yield nerds, let's get going on episode 93. We're going to play Yield Super Bowl. It has been a while since we played it, precisely 90 days. I have been waiting for some new news in Yield Super Bowl. I've been bored with just treasuries and agencies, and you are going to see something very surprising today. At least it was surprising to me. Couple of quick things. Hey, I want to make sure you know that even a blind squirrel finds a nut once in a while. So don't believe what I say. You need to do your own homework. And speaking of homework, if you really have time and want to do it, the best way to understand this show is to watch the playlist, and the playlist organizes content in sequential order. Having said that, thank you for tuning in. My usual disclaimers: I am not a wealth management advisor, and you make decisions. I'm sharing my learnings, and this is not tax advice, and I don't do product and politics, and I have nothing to sell to you. All right, how is Yield Super Bowl played? We take the most common fixed income instruments: treasuries, agencies, munis, corporates. Sometimes we take bank CDs. There was 1 week where bank CDs were the winner. This was the week after Silicon Valley Bank collapse. Look it up. It's an older episode. Having said that, we look at their yields for each duration and create a thesis of which one is best for that duration. Before we even do that, we make sure that we neutralize the tax treatment. So I bump up treasury yields by state tax because treasuries are not taxable at the state level. I also bump up certain agency bonds by state tax. Hint, hint. Again, you have to review if any of this is new to you. There are older episodes. Muni yields are bumped up by federal tax rates. And, we kind of play with different state federal taxes. And finally, corporate yields are fully taxable, so we don't bump it up at all. And if you thought Fannie Mae and Freddie Mac are agencies whose bonds are state tax deductible, surprise, they are not. So you need to review some material. Muni bonds are taxable in some states. And last but not the least, controversial as it may be, I use effective tax and not marginal tax. What I mean by that is I do not pretend that the muni bond income is always the last dollar being taxed at the marginal tax rate. I just don't buy it. I use the effective tax rate across the board. So now that I've given you context, let me take you back to episode 84. If you want to watch it again, here it is, episode 84. You will see in that episode that the story is the same old, same old. In the very short duration, it's treasuries, and then agencies run away with the rest of the durations. The rest don't matter. So I thought we'd go back and see how we are doing 3 months later. Surprise, surprise. Here is Yield Super Bowl as of today. Treasuries still are king and queen and minister in the very short duration. Tax adjusted, they are close to 6%, which is amazing. Guess what? Munis are the new king in the 9 months all the way up to 3 years. And so we have a new yield Super Bowl champion. How about this? In 4 years, corporates are the best. Amazingly, munis take the crown again in longer term. As you may know from my previous episodes, I am not looking at any window past 2 years. That's just me. You do you. But it still is a surprise to me that munis have come in very strong. So I was going to dig deeper. So I said, let me pick the two peaks to be clear. Sorry for going back and forth. At the 18-month and the 3-year area, munis totally destroy competition, and corporates destroy competition at 4 years. So we're going to start investigating what's going on. So here is the 18-month muni. We notice a couple of things. These are very highly rated. Hint, hint. Highly rated doesn't always mean that it works out. Moody's, the rating agency, gave Silicon Valley Bank an A3 1 week before it blew up. S&P said the Silicon Valley Bank was investment grade 1 week before it blew up. So I don't want to put all my faith in the investment ratings by S&P or Moody's, but for what it's worth, these are rated very highly. The thing that you note is that these are bonds that give very little in terms of coupon. If they give very little in terms of coupon and treasuries give 5.5%, That is the reason why they trade well below par. And when that happens, you get a yield of 5%, not because the coupon is 4.5% and it's trading close to par, but because the coupon is 2% and it is trading well below par. There are implications here. De minimis is something you need to think about. If that word means Latin to you, it is Latin. It means too small. And in this case, it is too big a profit. So think through that and make sure that you are buying the right security. Otherwise, you will be paying ordinary income tax on the gains. So here's what we're going to do. We're going to say, gee, I wonder how this gives 5% federal tax free, mind you. And so we're going to click on this little blue thing here. And here is the initial prospectus. And then we're going to go into greater detail. It tells us that the original coupon rate was 2%, and Moody's stopped rating it. S&P has a AA, which is pretty good. And so we're going to say, well, what is this bond? We see that it's the public school system in Harbor Springs, Michigan, and we're going to click the next level of detail. And once you do that, you realize that this is for the school district, and the entire town, the entire school district only has 8,500 people. I don't mean to say only 8,500 people. In the grand scheme of things, it is not a giant town. It literally has 10 administrators, 56 teachers, and the purpose of this bond is to pay off a prior obligation, and I'm guessing this is pension. And so this bond was issued to raise money to pay pensions of a prior bond that they are trying to catch up. So this is debt on top of debt in order to pay off pension obligations for the school system. All right, so let's see what else is going on. How do we know we're going to get our money back? Here is what the good people of Harbor Springs, Michigan are telling us. They are saying, look, you should trust us. If for whatever reason we don't have the money to pay you, we will just levy ad valorem, meaning value added tax, and we will levy it without any limitation. As long as the Michigan Constitution allows us, if you walk into the town of Harbor Springs, Michigan, we will keep taxing the people there until we pay your bond back. Trust us, we are good. Oh, by the way, one small thing, there is indeed a chance that the town may go bankrupt, they may become insolvent. Outside of that, we're going to pay you back. Trust us. That is the message from Harbor Springs, Michigan. So let's do a little bit of yield math. We're going to compare the 18-month muni with the 18-month treasury. And aside from the duration, there is nothing else in common, to be clear. The raw yield of the 18-month muni is 5%. I put a tax adjusted yield of 5.9%. I'm giving it an 18% bump, which is 0.9%. And here's why. You may remember much of your yield comes from the discount. And if the discount is very high, that means you will end up not paying capital gains on that discount. It will be treated as ordinary income. If it is treated as ordinary income, the difference between the 0.25% per year and the 5% that you got, 4.5%, is really going to be treated as ordinary income. So you will be paying a ton of taxes there. So your quote federal tax free is not really federal tax free. You'll get some benefit, but not a whole lot. Also, the good people of Illinois, you may live in other states, if you buy a Michigan muni, Illinois is going to say, too bad, so sad, I'm going to tax you anyway. So even though the bond is listed as 5% federal tax free, it really is going to be on a pre-tax level about 5.9%. Ding, 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 the brokerage will charge you some money to buy it. So the net yield is 5.8%. Well, I'm going to sit here and say in 18 months, is there a risk of default? Muni bonds do have a risk of default. They don't happen all the time. But when muni bonds do default, in general, people get their money back. But if it is a town of 8,000 people, it's a little bit up in the air. Now, what about the United States Treasury? 18 months, the raw yield is 5.26%. Add the state tax, you get 5.6. There are no fees. And so the risk of default is less than Harbor Springs. And there is no politician who is going to stiff the American bondholder. So even if there is a default, and we'll talk more about that in the next episode, November 17th is coming up. And even if there is a default, even if the government doesn't have the money to pay you that week, eventually they will pay you every nickel they are due, or no politician will be in office. So, having said that, the difference between these two is the difference between 5.6% and 5.8%, and you're placing a bet on a town of 8,000 people. You do you, not my place to tell you what you should do. But let's look at the 2-year corporates. Here we got a couple of things going on. The first is the top yield, 6.36%. That's just amazing. That is trading above par. Personally, I don't like to buy anything above par, because if they call that bond, then you are dead. You are going to be called at par. The couple of other things you're going to notice, the other ones giving you north of 6%, there are credit watches. What is a credit watch? Moody's thinks, I'm not quite sure I want to give them an A2 rating. And as these ratings go down, they are suspecting, and these are all banks, and as you know, banks have their own problems right now. So things are not looking that good for those. And now you finally come to this Dominion Energy, which is a utility for South Carolina, Virginia. This is a big utility company. It is trading slightly below par, and this matures in a year, so you have the de minimis issue here as well. The coupon is pretty reasonable, 3.6%. So you sit there and say, oh, maybe I want to buy Dominion because I literally only have a year left. And so let me look into Dominion. So let's dig into Dominion. In the last year alone, Dominion has lost 40% of its stock value. Is that a good thing or is that a bad thing? The real question is, do you own equity or do you own debt? If you're going to buy debt, do you care about the stock price? Within reason, you don't. And let me explain why. As long as the company is alive until December next year, you're going to get your money back because you are ahead of the shareholder. Now, Dominion does have a huge debt load because their market cap is 33 billion, but their enterprise value is 84 billion. That means they don't have a lot of cash in the bank, but they have a lot of debt. To review the definition of enterprise value from Value Investment 101, you can see the link there if you want. Having said that, you take a peek at their dividends and you're going to see that Dominion Energy gives 6.6% dividends. And you go, whoa, maybe I should buy that dividend. It looks like a phenomenal dividend. It's a utility company. And then you look at their dividend coverage ratio and you realize the amount of income available for the common shareholder, and that's the dividend you're getting, is barely enough to cover the dividend payment, which means if their earnings drop by 1%, they will have trouble covering their dividends. So left to me, and you do you, left to me, I wouldn't trust the ability of this company to keep paying that kind of dividend. I wouldn't be surprised if they drop their dividend. All right. What else is happening? And you say, well, where is all that income available to the shareholder going? And you realize, aha, their long-term debt to equity ratio is abominable. That is what is crushing it. And so you as a short-term bondholder is going to say, I don't care about the stock price. I don't care about the dividend coverage ratio. The flower is wilting, but is it going to be around for another year? And so the short-term bond investor says, PE ratio, dividend coverage, I don't care about any of that. If this thing will live for another year, I will get my principal back, my par value back. And that is a question you have to ask. If you think Dominion is going to live for another year, you can make 6% on it, and that is more than you can make in any other instrument. You do you. So if we do a little bit of yield math, let's see where that leaves us. The raw yield for Dominion is 6%. Tax adjusted yield, because it's both state and federally taxable, is still 6%. You do pay fees at Schwab or any other brokerage. So the net yield is 5.9%. I would argue there is a risk of default. I don't know whether it is significant. It's a big utility company, but it's non-zero. Your odds of getting money back, they still need to, the bondholder needs to stand in line. It may take time. You may not get the entire dollar. So there is that risk. But if you bought a 1-year treasury, you can make 5.43%. Add state tax, it's almost 5.8%. You do you for 0.1% incremental yield. Are you willing to buy Dominion instead of the United States Treasury? I'm not going to tell you what to do. You will know the answer yourself. In my opinion, we still have a single champion. It is the United States Treasury versus no one else on the other end. The Treasury is still king, short term is still king, corporate bonds are making noise, but my risk reward ratio is not making me jump into them. Munis are making noise. Some are really interesting. However, I'm going to wait longer and see where I go. On the limited edition yield Super Bowl, if I only look at treasuries, we are seeing what is called long duration steepening, meaning the short duration, this is just treasuries in the last 3 months, or September 22, a year ago, a month ago, and today, you can see that all across the board, interest rates have risen. However, something interesting is happening. Longer duration is going higher and higher because demand is decreasing. And so that creates some kind of an uncertainty. There may be a crash, there may not be a crash, so you got to be careful. When there is a crash, the crash will generally come in the short end. And when it comes in the short end, then you will get a non-inverted yield curve. So my strategy is to load up on two areas. I am going to load up a whole lot in the very short duration because I want to enjoy the higher yield. And as I indicated to you earlier, I am loading up on the 2 year just as a buffer. So that is my play. You do what you want to do. I do want to point out that there are some really juicy agency bonds that are available in the mid to longer term durations. However, you pay fees, so if it is not recently issued, so watch out. All right. The conclusion, in my opinion, is we have some very harsh disagreements between the two parties. I don't know if they are going to be able to disagree agreeably. We have problems with spending limits, debt, speakership, governance, and so on. November 17th is a big day. I think the earth is going to shake, unfortunately. And some of these high flying growth stocks, long duration treasuries, all of these may have some kind of a yield event in the middle of November. So here's what I am doing. I'm going into a lot of cash right around the middle of November. If there is a yield crash, I will start buying some of these bonds and equities. If there isn't, I will enjoy a higher yield and I will have cash to reinvest. And so that is what I'm doing. Otherwise, I'm still going to T-bill and chill. You do you. Thank you for listening to Yield Nerd. Remember, even a blind squirrel finds a nut once in a while. So don't take my word for it. Do your homework. Thank you.